Welcome to Primary Markets TV for Europe, Middle East and Africa, your update on newly issued securities. I'm Dan Barnes. Today, 30th of November, we're seeing the cross-border merger between the different Unilever businesses across London and Euronext Amsterdam, after which the company will become the single parent company of the Unilever Group. We have Helium One Global pricing its IPO on the 5th of December on the LSE this week, with an expected £6 million issue. N Brown Group is still to launch, expected on the 23rd of December, not 23rd of November, as noted last week, with a £100 million issue. On Nasdaq Nordic last week, we saw online bank Nordnet list with an €885 million IPO. And in Vienna, on Wiener Boerse, we saw Aventa AG on the 23rd last week, and Biogena Group on Friday the 27th. Euronext saw Alchimie list on Friday 27th, and Biogena in Paris on the 24th. I'm now joined by Naresh Aggarwal, Associate Policy and Technical Director at the Association of Corporate Directors, and James Deal, Chief Operating Officer at PrimaryBid. Guys, welcome to the show.
Thank you.
Morning.
Naresh, what's the environment for your members at the moment when they're trying to raise capital?
Well, I think it's a tale of many stories. So we know that for the well-organized, well-structured and large organizations, the markets remain very positive and supportive, whether they're looking at equity, debt markets, or just renewing bank facilities. There's definitely clearly a lot of liquidity available. We're hearing some price pressure with bank debt and the rates being raised as part of renewals. I think that's just part of where we are in the cycle. But for the larger, well-organized businesses, it is still very, very positive. And despite things like Brexit, they're all very positive around getting through the next year or two. I think for the smaller organizations, it's definitely a very, very different story. And I think there is a real challenge around how the markets are starting to dislocate and really creating a lot of challenges for organizations to, we've seen they can raise equity if they want to, but it's at a very, very expensive rate.
Yeah.
And the choices are becoming much more difficult to really assess between bank debt and actually issuing equity. Part of the challenge for a lot of our members is at the sort of the smaller cap and the mid cap areas where they either haven't gone to the market before, some of the teams are quite new, unfamiliar with some of the processes. I have to say some of them are quite shocked by the fees they're paying, especially when they don't have expensive roadshows. Anecdotally, one of our members in the US said he'd never believed last year he could raise $500 million sitting in his basement and not actually leaving his house. So there are some real questions about justification over some of the fees which organizations are paying. Even the sort of well-run and regular issuers, I think there's still some concern and expectation of fees actually coming down. One of the things that we talked about last year a lot is around the rise of ESG.
Yep.
I think it's really interesting how, despite COVID, it still remains a very important consideration, primarily for the investor community. Mm-hmm. And because I think it's still a very emerging question for analysts and for treasurers, there's still quite a wide range of maturity in terms of questions. So we hear some organizations, some investors ask treasurers, what type of green bond framework do you apply? And if you apply one, that's the limit of the questioning. Others get some really tough and really interesting questions and actually go away and rethink about how they're actually either presenting their case or actually looking at some of their ESG activities. And they see that as a real positive. So I think there's a growing maturity, but I think there's a lot more we can do around educating both participants.
And of course, the European project has been driving people towards raising capital via the capital markets rather than via bank loans. I mean, what are the costs of accessing capital across those two different mechanisms at the moment, and how do you see popularity changing?
Listening to a lot of the treasurers, I spend half my time talking to treasurers both here in the UK, US, and in continental Europe, big and small. Certainly looking at the debt markets, raising debt in public issues is definitely pretty cheap for most organizations. It's the bilateral facilities which are becoming more expensive. That is, I think, a sign of the fact that the banks are under pressure to raise margins as they're going to really struggle next year with increasing loan loss provisions.
Yeah.
So I think they're looking to increase their revenues. The corporates are obviously a good target for them. But very clearly, where good quality issuers are issuing in the debt markets, it's still pretty good.
James, turning to you, how have retail investors increased in importance relative to institutional investors as a source of activity in the primary markets?
Well, if you look at ownership of equities in the UK today, direct individual investors represent about 15% of the market. If you go back just for a bit of history, interestingly, in the 1950s, individuals were 100% of the market. There were no institutions. By the mid-80s, the UK market was about 30% owned by individuals. It hit a low in 2009 of sub 10%, and it's been rising since then. You've seen a spike this year in terms of trading volumes and ownership of equities by individuals. And I think that number is set to keep rising, not least because of the availability of information and the low costs of being able to trade shares as an individual. And in terms of strategically what matters here, if you look at the institutional end of a company register, so that's the other 85%, it's increasingly passive in terms of tracker funds, and electronic mechanisms are replacing, dare I say, the human element. So in that regard, it's very valuable for any company to nurture and support the individual retail ownership on its public company register.
What difference is the access that institutional investors have to primary markets? Or what is the difference between that and typically how retail investors access primary markets?
From a point of view of capital markets, when companies are raising new capital, so primary issuance of equity, there is a European rule or set of rules under the Prospectus Directive, which of course we will fall out of as we exit Europe. But those rules were put in place many years ago to protect the retail investor. And of course, all it's really done is block out the retail investor, because as a company, you prefer not to have to issue big documents as part of any issuance. It's costly, time consuming and distracting and so on. And so there's been this misperception on who is the retail investor. It's either been seen as a missold and a widow and orphan, or at the other end of the spectrum, of course, is a day trader who's in 1 minute and out the next.
Right.
The reality actually is the majority of retail investors have a long-term horizon of 3 to 5 years. And typically they are there supportive of companies they own. They come in and buy more. So retail represents strategically a very valuable source of capital in terms of day-to-day market support and liquidity. And look at the data from all of the trading platforms. It's testament to the fact that the holding periods by retail investors are far longer than anyone would care to realize otherwise.
And how are you actually changing access for retail investors into the primary process?
So as PrimaryBid, we are a web and app-based solution that allows the retail investor to come in to a transaction when a company is raising capital on the same terms at the same time as the institution. The world around us has evolved so much in terms of technology, and yet capital markets have not changed in any way for the last 20 or 30 years. So PrimaryBid provides, as I say, an access point on the basis that when companies raise capital, it's normally quite time constrained. To be able to reach individual investors is not easy, given the fragmented nature of thousands of individuals on a register. And that's what we solve for. So we put the transaction straight into the palm of the investor, either via your iPhone or indeed through your PC. And we give you full information. And as I say, pricing wise, the same terms as the institution. You transact directly, either via your phone or via your broker. And we settle the shares directly to wherever your broking account may be.
That's fantastic. James and Naresh, thank you both very much.
Thank you.
Thank you.